Let me quickly talk to you about the top 10 tax deductions for homeowners. Don't go anywhere. Welcome back, folks, to another edition of the Awesome Sweetie Kiwi Show. How you doing today? I hope you are doing fantastic. I'm doing marvelous, if you were to ask me. And if you are doing as great as I am, go grab a cup of coffee or tea or vodka and let's roll. Today I want to talk to you about an important topic. What are the top 10 tax deductions for homeowners? Let's just put it out there. What are the tax breaks for homeowners and home buyers? Now, one thing we have to really be careful about is that not all deductions are indeed deductions, because at the end of the day, owning or buying a home is very expensive, right? But there are at least some legit tax deductions, credit, and exclusions that can help you recoup some of those costs. And you can get some federal tax breaks for owning a home if itemizing deductions on your tax returns. Now, one thing I want to talk about here is that there are 10 that you need to think about this year when you file your taxes. Number one, the mortgage interest. This is usually the biggest tax deductions for homeowners who itemize in the United States, because a portion of every mortgage payment goes towards interest on the loan, right? So when you make your mortgage payments, you have the principal and the interest portion. So you can deduct the interest you paid up to a limit, which depends on when you took out the mortgage. So let's say if you took out your mortgage after December 16, 2017, you can deduct the interest on up to $750,000 of mortgage debt, or up to $375,000 if you're married and filing separately. If you got your mortgage from October 14, 1987 through December 15, 2017, you can deduct the interest on up to $1 million of mortgage debt and $500,000 if married and filing separately. So if you refinance the mortgage, the limits actually depends on the old loan's origination date. So let's say if the mortgage predates October 14, 1987, all the mortgage interest may be deductible. One thing you have to keep in mind is that your mortgage servicer will send a statement each year showing how much interest you paid. Number two, home equity loan interest. Interest on home equity loans and home equity lines of credit can be deducted also. But the condition here is that you've got to spend the borrowed money on home improvements, nothing else. Before the 2017 tax reform law went into effect in 2018, you could actually deduct the interest even if you used the money for other purposes, such as, let's say, college tuition or travel. But now, not anymore. The money has to go towards home improvement. So your home equity loan or HELOC debt, those two, either your home equity loan or your HELOC debt will count toward the total mortgage debt limit for deducted interest. So what I'm trying to say is, if your first mortgage is over the deductible limits, then the home equity loan interest will not be deductible. Number three, discount points. Now, if you are within the limit to deduct all your mortgage interest, you may also be able to deduct something called discount points. And those are the points you paid when the mortgage closed. So some borrowers will buy discount points to lower the mortgage interest rate. So one discount point costs 1% of the mortgage amount, right? One thing that I want to say is that, and I hear this conversation a lot, the term points can be confusing because some lenders call their fees loan origination points. Now, those points go toward paying the lender's cost for providing the loan, and they're not, I repeat, they're not tax deductible. So only the discount points paid to reduce the interest rate can be deducted. One thing you have to understand is that you usually have to pay points to the lender when you take out a mortgage, right? This kind of makes sense. In most cases, the points you pay on a loan to buy, build, or substantially improve your primary residence are fully deductible in the year you pay them. There are some requirements that you must satisfy, such as the loan must be secured by your main home, but you generally don't have to wait to deduct points paid for a standard mortgage. That's for the first part. On the other hand, if you're buying a second home, you cannot deduct the loan points in the year you paid them, but you can still deduct them gradually over the life of the loan. That means that you can deduct 1/30th of the points each year if it is a 30-year mortgage. When you refinance, you also typically have to deduct any point you pay, and you have to do this ratably over the life of the new loan. Number 4, property taxes. You can get a tax break for paying property taxes, but there is a limit. So you may deduct up to $10,000, and that's $5,000 if married and filing separately, of property taxes in combination with state and local income taxes or sales taxes. You get hit with all kinds of taxes, right? Not just income taxes. So as a homeowner, one of the additional taxes you're going to have to get used to paying is your local real property tax. This is the money that goes towards things like police, law enforcement, education, cleaning services, this kind of thing. The good news is that you might be able to deduct the state and local property taxes you pay on your federal income tax return. There are nonetheless a few wrinkles that can spoil this deduction. First, you have to itemize in order to deduct the real property taxes. That's very important. There's also a $10,000 limit, half of $5,000 if you're married but filing a separate return on the combined amount of state and local income, sales, and property taxes you can deduct. So the bottom line here is that anything over $10,000 is not deductible. Tax deduction for homeowners. Number 5, home office expenses. This is kind of cool. If you are self-employed and work at home, you might be able to deduct expenses for the business use of your home. So this deduction is available for homeowners and renters, and it doesn't matter what type of home you have. It can be a single family townhouse, apartment, condo, mobile home, or even a boat. You can also claim the deduction if you work in an outbuilding on your property, such as an unattached garage, studio, barn, or greenhouse. So folks, the key to the home office deduction, is to use part of your home regularly and exclusively for your money-making endeavor, because the IRS has very strict guidelines and very strict criteria for what qualifies as home office. So there are 2 ways to calculate the deduction. First, you have something called the actual expense method. So you essentially multiply the expenses of operating your home by the percentage of your home devoted to business use. Now, the problem with this method is that it can be a nightmare pulling together all the records you'll need to calculate and substantiate the deduction. And so that's for the actual expense method. You can also use something called the simplified method. And in this case, you deduct $5 for every square foot of space in your home used for a qualified business purpose. For example, let's say if you have a 300 square foot home, the maximum size allowed for this method, your deduction is $1,500. So employees, one thing I also want to add here is that employees who work remotely cannot deduct the cost of maintaining a home office anymore. That includes employees working from home during the COVID-19 pandemic. The thing here is that it's kind of a little sad, because before 2018, employees could claim home office expenses as a miscellaneous itemized deduction if the cost exceeded 2% of their adjusted gross income. However, this deduction was eliminated by the 2017 Tax Reform Act. Number 6, medical and necessary home improvements. So when you are figuring out your medical expense deduction, you can include the cost of installing healthcare equipment or other medically necessary home improvements that benefit you, your spouse, or a dependent. So permanent improvement that increase your home's value are only partially deductible. The deductible cost is reduced by the amount of the property value increase. All right. So many improvements to make a home more accessible, such as constructing entrance ramps, widening doorways, or installing railings and support bars, usually don't increase the value of a home and can be fully deducted. So you may qualify for a medical expense deduction if you install special equipment or make modification to your home for medical reasons. Let me give you a few examples. You have things like, if you add ramps, if you widen doorways, if you install handrails, if you lower cabinets, moving electrical outlets, installing lifts or elevators, changing doorknobs, and grading the ground to provide access to the home. There are some limitations though, folks. You have to itemize on Schedule A on Form 1040 to claim the deduction. I'll be right back right after this. Don't go anywhere. Welcome back, folks, to another section of the Awesome Sweetie Kiwi Show. We're also having a conversation today around the top 10 tax deductions for homeowners. Number 7, mortgage insurance premiums. Now, the cost of mortgage insurance is currently deductible. So this includes the amount that you paid for private mortgage insurance (PMI) for conventional loans and mortgage insurance for FHA loans. And this also includes the guarantee fee for USDA home loans and the VA funding fee for VA mortgages. So basically what I'm trying to say here is that the amount you paid for mortgage insurance is treated as mortgage interest according to the IRS. So to claim this tax deduction on your tax return, the mortgage insurance contract must have been issued after 2006, and your adjusted gross income must be less than $109,000 or $54,500 if married, filing separately for the tax year 2020. This is important. And one thing I also want to say is that the mortgage insurance deduction had expired at the end of 2017, but Congress extended it to include premiums paid through the end of 2020. Number 8, deductions for energy efficient upgrades. Now, most of the tax incentives for making energy efficient upgrades to your home have gone away. However, there are still a couple worth noting. You can still claim tax deductions on solar energy, both for electric and water heating equipment through 2021. So the longer you wait though, the less money you'll get back. Let me kind of give you a quick overview of the percentage of equipment you can deduct based on time of installation. So if you install between January 2017 and January 1st, 2017 and December 31st, 2019, you can deduct 30% of the expenditures as credit. If the installation happened between January 1st, 2020 and December 31st, 2020, only 26%. And if you had installed the equipment between January 1st, 2021 and December 31st, 2022, between January 1st, 2021 and December 31st, 2021, you can only deduct 22%, right? So basically, the idea here is that the authorities are trying to incentivize people to install those energy efficient equipment as fast as possible. Number 9, deduction of rental expenses. So, if you rent out a part of your home, such as a room or the basement, you will owe tax on your rental income, but you can deduct expenses for the rental space. So here, folks, I'm talking about people who are on Airbnb, for example, or other or similar platforms. This could be good for you guys. So potentially, deductible expenses include insurance, repair and general maintenance costs, real estate taxes, utilities, supplies, and more. You can also deduct depreciation on the part of the house used for rental purposes and on any furniture or equipment in the rented space. The thing here is that you don't have to itemize to deduct the rental space expenses on Schedule A either. Instead, what you do is you claim them on Schedule E on Form 1040 and you subtract them from your rental income. Right, but you got to really be very careful here because you have to figure out how much you can deduct if an expense covers, for example, the whole house, such as an electric bill or property taxes. So what you want to do in this case is you got to divide the expense and allocate a portion of it to the rental space. So you can use any reasonable method for dividing the expense. You can use the square footage. You can use a simple percentage. You can say, I will allocate 5% or 10% of the property expenses to the rental part of it. Number 10, forgiveness of debt on a foreclosure or short sale. So in the current pandemic, and which is kind of hard, and where the economy is down and everything is sort of a little down right now, more homeowners fall behind on their mortgage payments. In some cases, the lender may eventually reduce or eliminate your mortgage debt through something called a short sale or even foreclosure. Normally, when a debt is wiped clean, the amount forgiven is treated as income to the debtor. But when it comes to mortgage debt forgiven as part of the foreclosure or short sale, up to $2 million of discharged debt on a principal residence is tax-free. $1 million if married, filing separately. I want to emphasize the terms here: principal residence, not secondary residence. It has to be your main house. The exclusion only applies to a mortgage you took out to buy, build, or substantially improve your main home. So it must also be secured by your main home. Debt secured by your main home that you use to refinance a mortgage you took out to buy, build, or substantially improve your main home also counts, but only up to the amount of the old mortgage principal just before the refinancing. So this is kind of important, folks. And I want to mention before closing here is that no tax break is available if the discharge of debt is because of services you performed for the lender or for any other reason not directly related to a decline in your home's value or your financial condition. Besides, the amount excluded reduces your cost basis in the home. All right, so the exclusion is only available for mortgage debt discharged before 2021. So here you have it, folks. Those were the top 10 tax deductions for homeowners. And let me just kind of give you other relevant information that you might be interested in. Let's quickly talk about mortgage interest credit and homeowners costs that are not tax deductible. So in addition to the mortgage interest deduction, there is also something called mortgage interest tax credit available to lower income homeowners who were issued a qualified MCC, something called mortgage credit certificate, from a state or local government to subsidize the purchase of a primary home. So the credit amount ranges from 10% to 50% of mortgage interest paid during the year. Now, you got to look at the paperwork you got from the authorities to get the exact percentage that applies to you, because it will be listed on the MCC issued to you. The credit is limited to $2,000 if the credit rate is higher than 20%. Nonetheless, if your allowable credit is reduced because of the limit, you can carry forward the unused portion of the credit to the next 3 years or until used, whichever comes first. All right, now you got to use there's a form called 8396. That's what you have to use to claim the credit. And then what you do is you have to attach it to your 1040. You also need to report the credit amount on line 6 of Schedule 3 of Form 1040. Line 6 of Schedule 3, line 1040. Don't forget to check the box C and write 8396 on line 6 too. There are a number of restrictions and special rules for this credit though, folks. For example, no double dipping is allowed. Very important. If you claim the mortgage interest credit, you have to reduce your mortgage interest deduction on Schedule A by the credit amount. So if you refinance your original loan, for example, you'll have to get a new MCC in order to claim the credit on the new loan, and the credit amount on the new loan may change. One thing I also want to say is that if you sell the home within 9 years, very important, 9 years, you may have to repay all or a part of the benefits you received from the MCC program. And let me just kind of talk to you also about some homeowner costs that are not tax deductible. So things like home insurance premiums, homeowners association fees, transfer taxes or stamp taxes, cost of utilities, rent for living in the home before closing, cost for getting or refinancing a mortgage, such as a loan assumption, credit report or appraisal fees, depreciation, forfeited deposits, down payments or earnest money, wages for domestic help, all the like if you hire a nanny, so those are not tax deductible. Very important. All right, folks, this is the end of today's conversation. I really appreciate your attention today. Just kind of quickly recap it. We were talking about the top 10 tax deductions for homeowners. Number 1, mortgage interest. Number 2, home equity loan interest. Number 3, discount points. Number 4, property taxes. Number 5, home office expenses. Number 6, medically necessary home improvements. Number 7, mortgage insurance premiums. Number 8, deductions for energy efficient upgrades. Number 9, deduction of rental expenses. Number 10, forgiveness of debts on a foreclosure or short sale. And I also talk to you about the mortgage interest credit and the home and some of the homeowners costs that are not tax deductible. I will see you next time, but until then, remember, stay marvelous.